a lot of time to establish the key finance principles that underpin the course. We're going to be looking at them today before we get into the course content itself. But before we get into all that, I would really want to know with whom we are going to be having this brief journey together. Yes, it's a brief journey. With whom are we going to be having this brief journey together? It's going to be a brief journey for you and I, but finance is going to be a part of your life. It has been a part of your life already. It's going to continue to be a part of your life until you die. The only time you separate with finance is when you die. So finance is like marriage. Unfortunately, you cannot divorce from finance the way you would from a literal marriage. So it's still there to us part. So with that being said, I would like us to introduce ourselves. You tell me what you program your name, the program you're enrolled in, um, what you do. I think like that, so that we get to know ourselves and we understand the context under which the course is going to be taught. And then we can proceed from there. So we are going to start with Mr. Eyong. I see Eyong, I'm assuming that it is a man because Eyong can also be a woman. So please just introduce yourself.
Good evening, Doctor. Good evening to everybody. My name is
Good
Mr.
evening.
Ayon. I am an MBA student under the specialty for logistics and supply chain management, and I'm an engineer by training. Thank you.
Thank you very much, Mr. Eyong. Let's go to Madame Valdine. Madame Valdine, can you please unmute your microphone and introduce yourself?
Good evening. I am Ms. Nancy Valdin, medical doctor and MBA student under the Department of International Business. Thank you.
What do you do?
I said I'm a medical doctor.
Okay, you're a medical doctor. I'm sorry, I did not hear that. Dr. Valdine. Okay. Um, I see Simon Beswa.
Yes, doctor. Good evening, everyone. Good evening, doctor. I'm presently an MBA student in marketing, a trained corporate communicator, and a tutor on Preply.
Okay, thank you very much, Mr. Simon. We'll go to Mr. Nderene. The name looks very familiar. Is it the same Nderene that I already know? Please just introduce yourself to us.
Hello, Doc. Good evening to everyone. Yes, it's the same day, Renee, you already know.
Okay.
So I'm doing MBA in human resource. I'm a humanitarian worker. That's a
Okay,
brief
thank
about
you
me.
very much. Thank you very much, Mr. Nderene. It's nice to have you again. Let's go to Madam Sarah Mokake. I'm sure that's the last person.
Yes, Doc. Good evening, Doc. Good evening, everyone. I'm
Good
Kira
evening.
Mukake, an MBA student in accounting, and I'm an accountant by profession.
You're an accountant by profession, so you're a finance person. I see. Okay, that's good. So that's it. Now that we know ourselves, of course, I cannot guarantee you that I'll remember everybody's name now. But as we interact, I'll definitely remember. And then when we meet for exams, I'll be able to put names to the faces. But I'm sure you can see my face on my picture. If you had pictures on your profile, it will make life a lot easier. I cannot share my video because I don't have electricity, so you will not see my face, and my battery will run down much faster. Now, this is financial management. This is financial management. This course is very different from accounting. It's very different from accounting. Accounting focuses on helping us to be able to capture financial transactions, record the financial transactions, and then present this financial transaction in a way that makes sense so that the users of this information can make very informed decisions. That's what accountants do. But now financial managers do something which is a bit different. They do something which is a bit different. Their role is not really about how to identify transactions, record these transactions, prepare them into reports, and then present them. They have a very different role. Just like you hear from the name financial management, their role is involved with the management of resources. With the management of resources. So there are certain actions that this group of persons take that differentiates them a bit from accountants. For example, they do something which is called capital budgeting, which means that they plan how the organization is going to acquire and use money. So finance is a resource. And so financial managers are in charge of managing financial resources. In the same way, human resource managers are responsible for managing human resources. In the same way, logistics managers are in charge of managing the logistics of a company. So finance managers are also responsible for ensuring the thorough management of financial resources. And this management includes how the company is going to get money to be able to run its daily operations, how it is going to get money to be able to finance expansion. In the case where the company has a lot of money, finance people have to make sure that the company engages in the best investments possible. This is what financial management really is all about. So some of the things we are going to be looking at, for example, is analysis of a company's cash flow. Of course, like I said before, finance people are interested in how money gets into the business. So you cannot talk about how money gets into a business without talking about cash flow. And when money comes in, money definitely is going to go out. So where is our money going to? We'll be looking at cash flows, we'll look at cash inflows, which means that we are going to be studying how money gets into the business. And that's going to help us to make finance-related decisions. We are also going to study how money leaves the business, because the manner in which money leaves the business ultimately is going to determine whether the business is going to remain broke or the business is going to be able to have money at all times to be able to meet its obligations when they fall due. So some businesses are broke, not because they do not generate money, but because there is no control as to how the money leaves the business once it comes in. People who work in finance are the specialists who are in charge of ensuring that there are checks and balances in this case, so that money that comes in can stay somehow, be used, and that if it is going out, it's going out responsibly. Another big issue for finance people is risk. Dealing with money involves uncertainty. It involves uncertainty. Let me give an example. If you run a bank, if you are a manager in a bank, it is not clear how many people are going to do deposits in your bank in the next 6 months. You need to accumulate deposits every day, because that's what you use to make money. You take deposits that people put in, you give out loans, and then you now collect interest on these loans. So the first risk is that you might not be able to accumulate enough deposits. And if your bank is not able to accumulate enough deposits, then it means that you'll be running short of money to give out loans, because you must have enough deposits to be able to give out loans and to also be able to serve people who come to do withdrawals. If that happens, that you are not able to accumulate deposit over a long period of time, then your bank is at risk of closing. When you now give out these loans, there is a risk that people will not repay the loans. Remember that these loans like that, these are people's deposits that they come and keep in your bank. And if people take the money and then they do not repay them, it means you have to repay the people you took the money from. That's a risk that you have to manage. So every financial transaction involves a risk. It involves a risk. But this risk comes with some returns. It comes with some benefits. That's one topic we are going to be looking at. So this slide is designed to present you the course outline so that you have a global understanding of what we are going to be looking at throughout the course. Throughout the course, what is it that we are going to be looking at and going to be understanding? And we are going to try to make the discussion very simple, very practical, very straightforward, and very relatable to what we see daily in our businesses. This way we can understand sometimes why our companies will make certain decisions and why our companies will prefer certain actions that sometimes to us does not make sense. Once we have a finance perspective behind some of these decisions, a lot of things will start making sense to us. So some of the things we are going to be looking at normally should be to look at the role of the finance manager within the firm that we have already taken time to thoroughly explain. We are going to grasp some of the core concepts of finance, the very core concepts. And then we are going to touch on one of the first fundamental principles of finance, which is value. So throughout the discussion, you'll be hearing the word value in many different forms. You hear things like valuation of assets. You hear things like valuation of bonds. You hear things like valuation of shares. Finance is about value, assigning value to items. Once you acquire the skill to be able to assign value to items, then you make a very good finance manager. That's like the starting point for becoming a good finance manager. Then you can already see the next thing is that we are going to be looking at investment valuation. That's the second part of the course. Investment valuation. Again, the word valuation comes from the word value. Investment and valuation. When we understand the value of an investment,
Allô, bonsoir. C'est
please,
comment?
can we mute our microphone? Who is making a
Ça va
call,
très
please?
bien. S'il te plaît, je voudrais acheter la puce Camtel là. Je veux savoir s'ils ouvrent demain. Il faut juste quoi, la CNI, non?
Let me take a mute. Okay, thank you, admin, for muting the candidate. Please, can we mute our microphones for now, since we are not going to be participating now? Madam Kede, can you, I don't know if it's a madam, but I think Kede, I see Redmi A5. Can we mute our microphones? Thank you. Before I was interrupted, what was I saying? Good. I was saying that once we understand the value of a project, then it is easy to make the decision to invest in this project. And there are many different techniques that finance people use to understand the value of projects, to calculate the value of projects. These techniques that we use to calculate the value of projects helps us to have the valuation of these projects. Then it becomes easier to make decisions. Another big factor that helps finance people to make decisions, financial decisions, is risk and return. Finance people are always struggling to understand how much risk is involved. There is always a risk that you can lose money. Let's make it very simple. There is always a risk that money can be lost. But we will be willing to lose some money or take the risk of losing small money if we know that the returns that we are going to get far outweighs any loss we might make. Then we are going to make that decision. But now, different human beings have different tolerance for risk. Not everybody can take risk at the same level. We are going to, in this part, be looking at the different factors that will be at play and how different finance professionals will be behaving in these situations. We'll look at some theories, such as the efficient market hypothesis, that finance people use to form their judgment as to how much risk they are willing to take and how much risk they are not willing to take. Secondly, since we are talking about finance, it is virtually impossible to discuss finance without performing some basic calculations. It's like deciding to sell in the market. You will have to collect money from people and return change. So you have to do some addition and subtraction at some point. So do not be surprised if you see some addition and subtraction take place in the course. I would also like to remind that this is a master's degree course. What that means is that the calculations we are going to be looking at sometimes can get a bit complex. But we are master's degree holders or master's degree holders in the making, and we definitely can handle things that are complex. So let's not get frightened there. The last component of the course, the last part of the course, will focus on capital structure and financing. And capital structure basically is looking at where companies get money to start their business. Where do individuals get their money to start their companies? There are two global sources where we can get money to start our business. We can take our own money and put into the business as capital to start this business, as well as we can take money from somebody else. We can leverage other people's money and resources, put into our business, and then start off the business. Sometimes, what the business requires cannot be provided by us alone. So this is what some people might do. Some people might take part of their money and then borrow the other part, maybe from a bank, maybe from relatives, maybe from friends, maybe from a financial institution, or from somewhere else. The important thing is that it is a debt. So some people will take their money, their resources that they have, their money, put into the business, and then take another part which is from debt and put into the business. But now there is an issue. Which is more advantageous? Is it starting my business entirely from debt? In which case, I don't need to have a dime, I just go around and collect money from people, and then I can use that money to run the business, and the business can pay them back. Is that the most advantageous approach? Or what if I do not take debt at all? I take entirely my money that I have saved, and then I start a business. Is that approach more advantageous? Or would it be better for me to do a combination of debt and my personal money? So I have my money, I take part of that money and I keep aside to start my business. The other part which is required to start the business, I decide to borrow and put. Are there some advantages to doing it like this? That's a big question. Another big issue also comes up with, if I decide to use a combination of debt and personal finance, my personal money, to start up this business, what's the best combination? What's the best combination of personal finance and debt that I should put, together as capital to start my business? What's the most appropriate combination? What would you do as somebody who understands finance? When we get to this part of the course, we are going to understand what the best approach is going to be. And the best approach is that there is no best approach. The best approach will be determined by the business in question. Now, since we have our ELAP projects and the different projects that we are going to be doing, you can consider this a gift because some of you have been charged to raise finances, to raise capital, to do many other things. And this course is going to provide all the tools that you will need to do that. How are you going to raise money for your cohort? Would you get money personally? Would you borrow? Are you going to get money from shares? Are you going to get money from bonds? Is there any kind of other financial instruments that you can put together locally to get this money? What even is a financial instrument? These are all the things we are going to be learning about in this course. So if we did not know financial instruments before and how we can use them practically, then we have to pay very careful attention to how this course is going to develop from here moving forward. So these are the four parts into which this course has been divided into. You have the finance manager and the core concepts of finance, which is what we are going to be looking at today. We have investment and valuation. And like I said, valuation is going to cut across the entire course. There is no part of this course we are going to be discussing where we shall not be looking at valuation. Also remember what I said. Valuation comes from the word value. And finance is all about value, assigning financial value to items, to instruments, to assets, to securities, and to many different items as we are going to be seeing throughout the course. We also said that a major factor in making finance decisions is risk and return. What's the risk involved? What are we going to be getting in return as a company? What are we going to be getting? What am I going to be getting in return as an individual? In the case I am running the business personally, or in the case of personal finance, these questions like this will help me to make the best decision possible. And lastly, where do I get money from to start my business? That's the meaning of financing. Financing is where will the money to start, run, and grow my business coming from? So if I've not started my business, where will I get the money to start my business from? If I have already started my business and now I want to expand this business, where would I get more money to start and grow this business? Financing. financing. Then capital structure. What's the best combination? Or what's the best option for getting the money? Should I get the money personally? Should I work hard, save, then I can start my business? Or should I leverage on other people's money? Should I borrow and start my business? Or should I save part and then get part to put together? As a globally, this is what we are going to be looking at in the course. So before we, this is how the course outline itself is presented. Let me just show you the course outline. This is how the course outline is going to look. As you can see, it's raining very heavily where I am. Please kindly indicate if you can hear me.
Lord Dog, we can hear you, but it's
We can
you
hear
are
you, sir.
struggling.
We can hear you.
I paused it. I paused recording due to the rain and then I forgot to start it back. So as I was saying, the financial system has four main components. We know what a system is. It's a collection of parts that all work together. And these four main components are financial markets. Then we have intermediaries. So in the financial markets, this is where stocks, bonds, and other financial assets are sold. We are going to have an understanding of what financial assets are, what stocks are, what bonds are much later in the course. But just think of it like any market you know of. In these markets, people go there to buy and sell. The second thing I want us to keep in mind is that in any market, the people buying and selling are not necessarily the creators of the products, but the market acts like the environment where people can acquire products from the creators and then come to these locations to exchange them. So the market may not necessarily be a location per se, like a physical location. The market is more of a condition. It's more of a condition that permits people to come together and then exchange in any form. So we have gone past the era where markets were physical locations. We've gone far past that. So this is the first component. The second components now are the intermediaries. So in the financial system, we also have intermediaries. And who are these intermediaries? They are banks, they are insurance companies, they are microfinance institutions, or any other institution that connects the creators of money with the users of money. So there are a group of people who create money, and there's another group of people who have to use the money that has been created. And who helps the creators to be able to pass on this money to the users? The financial intermediaries. Then we have service firms. The service firms exist because there are regulations that guide the system. As we deal with the financial system, we have to be able to follow certain regulations, certain rules. And many times, the average person is not an expert in finance. And so there are service firms that exist in order to provide advice and assistance with preparing and participating in this financial system. All firms that are involved with providing advice, to declare their tax, helping companies to do tax payments, finance consultants, all of them fall under service firms because they make sure that the people who are using this system are informed about the rules and regulations. They ensure that these people are able to implement these rules and regulations and that they do not get into trouble for lack of ability to implement or lack of understanding. So they also fill this very important gap. And then we have the fourth component, which are the regulators, the people who control, who create rules, and who enforce all the rules that exist in this system. So we know that no system exists without rules. No system exists without rules. But now I have one question for us. Where do we fall inside this system? This system has to accommodate all of us. So I need somebody to think about this and then tell me where they fall. Where do you think we all fall inside this system? Where's our place? Where would you say we find ourselves? Let me see. I'm sure it was Madame Ruth who told us that she's an accountant. Can you tell us where we find ourselves in the finance system? All of us who are here, MBA students, where do we find ourselves? In which of these components do we belong? What do you think?
The service firms.
Yeah, explain. When you give your answer, you have to defend it now. Why do you think you belong in the service firms?
As financial managers, we are here to advise, to
Okay.
provide that service. Yes, so I think basically that's where we'll fall because it's our role to provide the
Finance
financial
manager.
users, yes, the advice and every information that they will need.
I am back. My apologies. My internet disconnected a little bit. What somebody was talking. I'm sure it is. I'm sure it was. It was Madame Polo Pelagie. Yes. I was asking. I was trying to understand why you say that you belong to the service firms. Somebody else can speak up. Let me call names because I cannot see faces. Let me find out. Mr. Nderene, what do you think? Where do we belong? As MBA students, where do we fall here?
No, Doc, as MBA
Yeah.
students, one of our colleagues said we fall in the service firm, but also it depends on where you're actually practicing or applying your skills as a financial manager. If you are in a bank, okay, banks and insurance, you also need to apply this there. For some people who are into stock markets, buy and sell shares, they are also part of that financial system. Some people, some of us are involved in it. So in essence, we fall in different parts at different times based on what we are going through at that particular time.
So where do
So I
you
think
so where do you fall?
for me personally, okay, let me just say, for now I fall in the service. We provide advice on how we manage our taxes as an international NGO, but also over the past year, I've also had experience with the regulatory bodies on the tax audit that we are going through. And so I've seen that happen as well. We have to recruit KPMG and the other firms to work with us to try to make those things pass. So that's why I'm saying at different stages of the career, I've been able to see it, or I've been able to be part of the different aspects that you have mentioned here.
Thank you very much. We hope that one will be analyzing some good cases. That experience is going to be, we're going to learn a lot from that experience you've been able to acquire. Let us take Mr. Eyong finally before we proceed. Mr. Eyong, where do you belong in the financial system? Mr. Eyong there?
Yes, sir, I'm there.
So where do you think you belong in the financial system?
So I can't seem to really place a finger. Because to me, from the way you explained it, the whole system is intertwined, means every part is kind of like interacting with another part. I'm talking about the 4 different portions. So
Yes.
there are moments in time when we interact more with the stocks, and there are other moments where we seek for advice. And there are times when the regulatory bodies themselves implement policies which affect us, those of us who are in the other 3 main quarters. So for me, I just think it's kind of like a mix of the 4.
Yeah, I'd love to
Yes, of
say
course. That's
something.
why. Okay, go ahead. Go ahead, Simon.
So I think we belong in the service firms because financial managers are part of a company. They operate under a company. So they offer their services, they give their expertise on financial management and everything. So they consult them, they ask them for advice and also how to prepare for tax and all of those things.
Okay. Thank you very much. Now, just keep in mind that a system means that every part affects the other part. A system means that things are connected. So if you do something to one part, other parts, 2 or more parts are going to be affected. But that, however, does not always mean that we belong to every part of the system. That's not the case. Now, if I am a financial manager, that does not automatically mean that I belong to the service firms. No. The service firms are licensed providers of financial advice. Licensed providers. So you have finance consultants and companies that are providing advice and guidance for preparation of taxes and other financial issues. Very important to be very clear on that. But everybody is a part of the market. Everybody interacts in the market. The intermediaries are found in the market. The regulations take place in the market. But now the regulations is the organ that ensures that there are rules in place for everything to take place fairly. So that the market operates fairly, regulation is extremely important. Okay, I know that many of us have other opinions. We are going to be sharing them as we move forward. Let us now, we will not talk about why institutions differ and why they change, because it's obvious. But we are going to just look briefly at the 6 functions of the financial system. Financial systems differ between countries. They depend on the size and complexity of the system in a country. But there are 6 key functions of the financial system that do not change, that you find everywhere. The first one is transfer of resources through time and across border. Pay careful attention here to time. We are transferring resources through time. In one of our chapters, one of the very early chapters of the course, we will engage in an exercise that will behave as if we are traveling through time when we are doing investments. The second function is to manage risk. We'll discuss that in more details later. The third is to clear and settle payments. So sometimes we do transfers across borders, across countries. If I am in Cameroon and I do business with a company in the US, and at the end of the month, I go and send money to that company in the US, how exactly are these payments sent? How are they cleared and settled? Is it that the money travels from Cameroon to the US? How does that work exactly? We are going to understand that. They pool resources and then they subdivide ownership. This is still financial management. Instead of starting a business alone, I can call 4, 5, 6, 7 persons. We pool resources together. We subdivide ownership. We all become owners of the business. Then we can grow that business easily. Provide information on prices. And then we address incentive and information asymmetry. So what this simply means is that we prevent a situation where some people can take advantage of the market because they have access to internal information that everybody else does not have. We are going to discuss how resource allocation and other things are done to ensure that someone with a specific insider information does not take advantage of the market. For example, I am a lecturer at Fort Hare University, and the board chair has held a meeting with the board to announce the creation and sales of new shares. And I know that the board is planning that the first 20 shares will be sold at 500,000 francs per share. But the next 40 shares after that will be sold at just 250,000 francs. Now I have access to this information that everybody else does not have. I can decide to wait and only buy shares after the first 20 shares have been sold. How does the system act so that situations like this will prevent me from taking advantage of this insider information to benefit myself more and things like that? So these are the 6 functions of a financial system. It's very important for us to be able to understand the background under which financial systems operate, so that when we are making decisions as MBAs, as business owners, as managers, we would have all this context behind us. Now, this is what I really wanted us to talk about today. The 10 principles of finance. The 10 principles of finance. Please indicate if you can hear me, because the rain is really loud here. So I'm also speaking much louder. So I need to be sure that we are following. Okay. See, people are raising their hands to confirm. That's good. So what are the 10 principles of finance? These 10 principles are going to underline everything we are going to be looking at in the course. These 10 principles, very, very important. So pay very keen attention to them because you're going to be needing and you're going to be using them. So these are the first 5. The first principle is the time value of money. As we travel through time, the value of money reduces naturally. This is not devaluation. It is just a natural effect of time that time has on money. So in finance, money that you have today is worth more than money that you have tomorrow. So 5,000 today has more value than 5,000 tomorrow. That is why if I give you money as a loan today and you decide to pay me tomorrow, you also have to compensate me for waiting to collect the money tomorrow. That compensation is what we call interest. That's why you see we say money grows at a positive interest rate. Because time causes the value of money to reduce, as time is passing, interest rate is used to balance off that loss in value of money. That's why if I have 2 million francs today, I cannot buy the exact same piece of land that I'll buy today in 10 years. In 10 years, to buy that same piece of land, I might need like 10 million francs. Of course, that's the evidence that the value of money has reduced as time has passed. We have the law of one price. This law simply states that if 2 or more assets are equivalent, then they will be bought and sold in the market at the exact same price. That's it. If 2 things are entirely equal, then they are going to cost the exact same price. That's it. Then there's no free lunch. There is no free lunch. Nobody gives you money for free. It doesn't matter how you want to look at it. Nobody gives you money for free. There is always a trade-off involved. There is always a cost and a benefit. The benefit may not always be financial. So I might render a service to you today that you might think is for free. But that can make you entitled to also help me in the future. So there is no such thing as a free lunch, like somebody did something to you for free. It's not possible. There is always, you are always going to pay back in some way. You can argue with this concept as an individual, but it's a principle. It is always true. It is always true. That is why in some companies, they do not want you to collect tips from people after you render them a service. Because collection of tips, sometimes you will not pay that person back in cash for that tip, then you will pay back in kind. Naturally, you will be compared to the software on that person to give that person preferential treatment whenever they return to your company. That's why some places, it's a policy that you don't give people tips, or that tips are not allowed. No free lunch exists. Principle number 4. There is no complete model. In this case, what is a model? A model in finance simply explains how people make money and how people spend their money. If we take the case of someone who has their small business, the simplest model for that person is that they make their money through sales and they spend money on themselves personally, and when they buy goods to stock their shop. That's the simplest model. But that model is very incomplete. If you go into that individual's business now, you might find that the reality is far more complex than what you see. So every model that we are going to be discussing in finance is a simplified version of a very complex reality. So we are always going to be making assumptions. We are always going to be making assumptions. For example, we are going to study the market security line and the capital asset pricing model shortly. I will not explain what they are now because to explain them would mean that I have to go into the details. But when we are going to be discussing those models, in order to make them as simple and understandable as possible, we will make certain assumptions about the financial markets. We'll make certain assumptions that will make discussing these models really easy. Assumption number 5, sorry. the best estimate of the value of anything is the market price. That's the best estimate of the value of anything you are going to be dealing with. How much does that thing sell right now in the market? Do not make any estimate in finance that is based on what you think is the value of that item. The estimate should not be based on how much you bought it. The estimate must be based on what is the current market price of the item. All estimations that we make throughout the course must be based on this principle. So just consider these principles like the 10 Commandments. Read them, understand them, master them, because they are going to make sure that things that would otherwise have appeared complex become very simple and easy to understand. Very simple and easy to understand. So the best estimate for the value of anything we are going to be doing is based on market price. Market price. This is very important because we are going to be looking at many different methods of valuation, many different methods of estimating the value of assets. But we are already telling you right now that amongst all these methods, the market price is the best estimate. Pay attention. The market price is the best estimate. The rain is very heavy at my end. These are the last 5 principles of finance. Principle number 6, risk is fundamental. Every financial activity involves uncertainty. Every financial activity involves uncertainty. When the MBA session for this year was launched, it was not possible to know exactly the number of people who are going to enroll. It can even happen that nobody enrolls for the program. It can happen that more people than we planned enroll. That's a risk. That's the uncertainty. We cannot know exactly how the outcome is going to be. We can make predictions. We can make estimations. We can try to project based on data that we have, but we still can never be certain. That being said, there is always risk. It's never possible to be 100% certain. Because there is risk, naturally, I will not engage in something that will not provide any benefit. That's why we speak of risk-return trade-off, which is principle number 7. We would only engage in investments that will provide some level of compensation for the risk that we are going to face, even though sometimes we do not even know exactly what the risk will be. Sometimes the risk that occurs when we are running a project is a risk that we do not even foresee, we do not plan for. We held many planning meetings. We looked at what could go wrong. And even after holding all those meetings, the thing that finally goes wrong is not among the things that we were trying to predict. That being said, I would only engage into something if I am expecting some form of reward, some form of compensation for having taken risk. It's a bit like asking somebody to jump from a building for free. Ask somebody to jump from a 3-story building for free. They won't do it because that's too much risk for no reward. But ask them to jump from a building for 2 billion francs CFA. So somebody who likes risks might reason that I can jump from this building, but I will not die. I'll break my legs. But I can use 300 million to treat myself. And then I use the remainder of the money, which is above 1 billion francs CFA, to set up myself financially and achieve financial freedom forever. So this time, because there's a reward, somebody might decide to take on a risk. It's the exact same thing. This is the reason why banks give out loans, because there is compensation at the end of the loan. Principle number 8, flexibility has value. Please, cohort members, pay attention to this. Ability to adapt to uncertainty has a lot of value in finance. So when you're presenting your project to investors, do you take time to show them how flexible your business is? How easy it is to adapt when things that we could not predict happen? How easy it is to adapt to future decisions? There's a lot of value in that. If you cannot show investors your ability to adapt to uncertainty, I am not sure that investors of today will be willing to really work with you. Because investors always have this question at the back of their mind: what if something goes wrong? What if something goes wrong? What if this happens? What if this thing you're planning doesn't work? What if you don't make this 7 million francs profit you're telling us? What happens then? You have to be flexible. We have to be flexible. We have to be able to adapt very easily to future fluctuations of situations. Now, having said this, these first 3 parts I have talked about in this part will involve a lot of probability calculation. So we are going to be teaching you how to use probability to determine the best possible outcomes and to also prepare for uncertainty, adverse outcomes. But now there is a big issue. Every business is always only preparing for adverse outcomes. Many times business do not know that companies have closed because they were not prepared for opportunities that were actually very good. So sometimes the outcome is very good, but we still were not prepared for it to be that good. And so we are not able to manage it. We are not able to manage it. I have seen situations where a company that is producing bottled water finally goes far beyond their projection for the year. So they finally get a contract to be able to supply I think 1.2 million tons of water in a 6-month period. And that instead causes them to shut down. But you would think that that's a good opportunity for them to grow, to make profit, to make money. But they just were not prepared for that kind of sudden growth. So when they were anticipating everything that could happen, they were only preparing for what could go wrong, but they were not preparing for growth to be so sudden. Again, failure to adapt to future decisions as uncertainty results. We do not plan only for failure. We also plan for when success comes and it is far beyond what we expected. Are we going to be able to cope? Very important. Extremely important. Number 9. This one is like the backbone of finance. There is no finance without trust. Transparency and verification supports financial transactions. If there is no trust, if we cannot verify the financial transactions you are engaged in, then the whole finance system can crumble if there is no trust. That's why honesty and trust is the biggest qualification for working in a finance role. We have to keep things confidential. We have to be trustworthy. We should not be thieves. We should not be dishonest. Sometimes we can be dishonest without stealing. It's very possible. We are going to look at case studies where dishonesty took place, but no theft. The company did not lose any money in the process, but things happened that were really dishonest. We are going to analyze case studies of that nature. And finally, the last principle is that the core financial functions are universal. They are the same everywhere on the planet. Everywhere on the planet. If you want to acquire a piece of land everywhere in this planet, you must be willing to lose something of value. Money, anything. The core financial principles are universal everywhere. They are not different in Cameroon and different in the US. They are not something else in Ghana and something else in Equatorial Guinea. The fundamental concept for finance and all these principles we just looked at are basically the same everywhere. So class, these are the 10 principles of finance that we are going to be looking at. It will cut across the entire course. As we start the first chapter, which is going to be the time value of money, and the valuation of bonds and assets, we are going to see how all these 10 principles are going to be playing along. So with every chapter we are going to be looking at, every one of these principles is going to be playing a very key and fundamental role. Now, if you have any observations, any question, anything you'd like to understand further, you can ask it now. You can ask the questions now. You'll be waiting for. Are there any questions? Any observation? Madam Mukake, you want to say something?
Yes, sir.
Okay. If there are
So I
no
have a
questions,
question.
there are not. Okay, go ahead, Mr. Young.
Yes, I wanted to find out. Presently in my mind, I seem to have a mix-up with the first two principles or assumptions. The first one you
Okay.
spoke of was the time value of money.
Yes.
Like you just paraphrased it by saying the value of money is never the same. That means the money we have today is never going to have the same value tomorrow.
Yes, of course.
Then in the second principle, we have the law of one price, which states that for the same goods, the price at which it is sold and the price at which it is bought is always going to be the same, at the same price. I don't know if I got it right at that level.
Yes, that's it.
Okay, but in my mind, it's a little bit like a contradiction. I don't know if I'm getting it right because I can buy a good right now, say a charger. I can buy a charger for say 500 francs now, and I return it back to the
Yes.
shop. Let me say in one week's time. Maybe the value of that price of that charger may no longer be the same. For example, the person may say I've used it is fairly used, so maybe the price of that same good is no longer the same. So I don't know if yeah.
Yes, thank you, because in your question, you have already provided the answer. It is no longer a new charger. It is now a used charger. So it cannot be sold at the same price with other brand new chargers. Now, there are two things we have to keep in mind. When we are moving in time, the value of money will change. The value of money will change. And the value of money is usually represented by the purchasing power of money. Secondly, this second principle simply says that if two things are totally equivalent, then they should have the exact same value. So if you take a charger, you use it and you return it, it's now a used charger. Even you, if you go to the shop to buy a phone and the phone has been used by someone, it has become a used phone. If they want to sell that phone to you at the price of a brand new phone, you will not accept, because it is not the equivalent of a brand new phone. It is a used phone. You understand? That's why if they bring you an iPhone 11 which is sealed, you may be willing to buy it for 200,000. But if it has been used, you may only be able to buy it for 120,000, because you argue that it is a used phone. So it's no longer equivalent to a brand new phone. Now, this is a principle. If two things are equivalent in every way, then there is no reason why their prices should be different. If you and I have two laptops, these two laptops have the exact same value, then they should have the exact same market price. That's the argument that finance is making. That's the principle. This is totally different from talking about how the value of money changes over time. You understand? Now, to also demonstrate this, in 2015, for example, when iPhone 11 just came out, they were purchased at almost 1 million francs, right? Would you purchase iPhone 11 today for 1 million francs?
Not possible.
The answer is no. So the price of every iPhone together has changed over time. So as time has passed, the value of the iPhone has dropped. It cannot be compared to iPhone 17 now, which is selling for more than 1 million francs. So nobody will buy it again for 1 million and things like that. So that's it. To buy an equivalent phone over time, the price is going to change. But if we are looking at the exact same time frame today, for our time frame is today, any two things that have the exact same value should have the exact same price in the market. They should be bought and sold at the exact same price. There's no reason for one to be more expensive than the other. I hope I've been able to provide clarification.
Thank you, sir. It's clear now.
Okay. This class appears to be very smart. People don't have questions or comments. I think I'm very impressed. I'll be sharing assignments on your group, individual assignments and group assignments. I'll share them on your group, on the WhatsApp group. And by the way, the assignments will be on the learning management system. And then I'll just send the instructions on the group so that you can follow to do the assignments. Please take individual assignments very seriously. Take individual assignments very seriously. They form a good part of your continuous assessment. Also take group assignments very seriously. And then also remember that as we start discussing the core concepts of the course, the core topics of the course itself, we shall be using your cohorts as examples. So we are not only going to be analyzing case studies from outside. Some of the cases for analysis that I will be bringing to class will be your own cohorts and the things that you are doing currently or that you are supposed to be doing. The case studies may be built around that. So your cohort will be using that for group assignments. And then you have individual assignments that will test your understanding of the concept because you have to understand them so you can apply them. So if you have any questions, any observation, this is a good time to make it before we end our session for today. Okay, looks like there are no questions and there are no observations. Thank you guys very much for your time. And we are going to continue next week. So I think tomorrow or Sunday latest, you are going to receive more materials, more updates, directives on how to get to the textbook on the learning management system, your different assignments that you are going to be doing. Just know that you'll be submitting assignments for this course weekly. There's a whole series of weekly assignments that I'm already preparing. I'll start sharing them on Sunday. Every week you'll be submitting assignments. Just prepare. If your assignments come after the deadline, please, I'll not mark them. I will not mark assignments that come after the deadline. You have the flexibility of the entire week to prepare assignments. I know that you are busy professionals. I really do. I'm also busy. But I know that with good planning, with very good planning, you can complete your assignments and do an amazing job when it comes to meeting your cohort targets and your other learning objectives. Thank you very much and see you in the next class.
Thank you, Doc.
Sir,
Yes.
I wanted to just
Mr. Ayongo,
inquire, please, can we have a copy of the course outline? It helps us prepare before coming to the class too. I don't know.
Yes, of course.
right.
Everything will be provided on the learning management system. When you go to the course on the learning management system latest Sunday, I'll drop directives on the group. The course outline will be uploaded there and you people will be able to access it from there.
Okay, thank you so much.
Okay. Thank you very much for your time. I wish you an amazing weekend.